Will big tech be a big disappointment this earnings season? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Tony Greer, editor of the Morning Navigator newsletter. Hi, Tony.
Sorry about that, Maggie.
That's okay. I was like, I know I we always know that Tony's glued to his terminal and all of his price action. This is always a tough time of day. So it's right when
Yes.
things are closing. But as usual, we'll be taking questions. So you know what to do. Drop them in the chat and we'll get to as many as we can. So Tony, let's start with equities. Because we didn't see a whole lot of action today. But we are really going to get into the thick of earnings this week, and we've got some really big tech ones on the schedule that I know a lot of people are going to be watching. The Nasdaq down a third of a percent today, but year to date, uh, it's been outperforming. I mean, it's up almost double what S&P is. How are you feeling about tech right now?
Well, this is like the pullback in technology since tech, broke out off the lows and reversed with the rate reversal that we saw in March. So this month has been a little bit of a give back in that technology breakout. We've had in April, for example, we've had a slight tick higher in yields over the course of the month, which has set technology sort of back behind the S&P for performance wise in the last couple of days. I think that it basically speaks to the fact of whether rates are going to continue lower and the dollar is going to continue lower from here. Maggie, that's sort of I'm centered very much in macro land while I'm watching the stock market rotate around 4,100 in the S&P. But to me, the more important signals are going to come from watching the yield curve and from watching dollar. Quite honestly, the yield curve is still buried at minus 60 basis points. Again, we're talking about twos, tens. We're expecting the curve to start steepening with this rate reversal that we're expecting from the price action in March. And right now, the yield curve is wedged between moving average support and moving average resistance. So until we break the range of sort of minus, call it 55 basis points at minus 70 basis points in twos, tens curve, we might do a lot of equity rotation around 4,100. So we'll see what happens. But I think my sense is, that the path for yields, the path is lower. The path for the dollar is still lower. We're in a situation now in the dollar index where it backed off to its lows of the year. Everyone is really max bearish with the de-dollarization theme that's
Yeah.
going around. Today there was a fresh headline about, 19 countries looking to join the BRICS, and we've got Saudi Arabia in there now. And so it's getting, the geopolitical complexion is certainly changing. I don't know. I don't expect the dollar to to lose its reserve status anytime soon, but I do expect it to trade lower. So, when we break that bottom of the range at 103 quarters, I believe it is in the dollar index, then it'll shake up the market a little bit. But until then, it seems like we're really, really range bound across a lot of asset classes right now.
Yeah, and really searching for the catalyst to get over it. But we know we've got some econ data this week, including GDP and an important inflation gauge on Friday. But then we have the big jobs number next week, and of course, then we're looking for Fed early May. Are you just in a holding pattern to that? Are you trying to position ahead of it? How are you going to go into that meeting with so much uncertain, so much up in the air?
Yeah, there is. We're in the middle of a big economic battle between, the big pending Western recession and, China's reopening. And we know that their sort of airlines are back to about 70% of the pre-lockdown capacity. So that would be pretty optimistic going into, the big golden week at the beginning of May when they go on vacation. So we'll see if jet fuel demand is there. But that's the battle that's going on right now. With the curve down here, we have to expect, downside surprises in economic data and a lot of turbulence to ride through. And that's exactly what we're seeing. 2 weeks ago, we got that totally, totally benign inflation data across CPI and PPI. Then last week, we got a mixed bag of data all over the place. And, we got housing data, we got some inflation data. Um, and it was totally mixed. So there's
Yeah.
nothing that's, like you said, there's no catalyst to shake us out of this range immediately. I think that the theme that persists in the stock market in the US is that, yes, we're heading toward a recession, which I really don't argue much with or about, and that, yes, that's necessarily going to be negative for the S&P, which I have no idea where anybody comes up with that argument, but it's fine. And so we need both sides, two sides to the market here. Sentiment feels negative to me, and that's why we're stuck here rotating around S&P 4100 and not dunked down below it. It's because everybody's so negative, and there are actually a couple of bull markets to be observed around the market. So
Yeah. Yeah, no, that's a great recap, and it's kind of what everyone's grappling with, and timing is the really tough part, right? So, as you say, everyone expecting a recession, a lot of people looking at China's reopening. Andreas talked a lot about that for those of you who haven't got a chance in the latest steno signals, not the one that's coming out this week, but the one that was out last week, and what that might mean. But again, you've got this short term and then longer term. When does this all happen and how much do they offset each other? It's kind of a tough call, especially in the shorter term, because I know you usually focus pretty short term.
yeah, that's why I want to, I'm never, terminally bearish about activity, because there are breakouts to be had on this tape.
Yeah.
We just rotated into home builders, into ITB, into that ETF as it started breaking out. Gold miners have broken out and are pulling back a little bit, but they're very much in play. You've got to trade the trades that the market's giving you now, and it feels like the market's giving you those rate trades that happen when yields back off, and hopefully the curve steepens, but we don't know yet. But if we are going to go into an easing cycle rather than in a tightening cycle, then you would expect to see some strength in gold, and you'd expect to see strength in home builders with lower mortgage rates, et cetera, et cetera. So I'm just trying to pragmatically and very tactically and carefully approach the trades that the market's giving us, Maggie. I think that's about the only thing I could do in this tape.
Yeah. I saw oil up today. We've talked about this because this is where you're also the timing issue. You are structurally, I think it's fair to say, bullish commodities in the sort of long term, that narrative. But short term, you've been also just letting the market show you where to go. It looks like the oil market is paying a lot of attention to that China story.
Yeah, yeah, it's easy to remain sort of structurally bullish but flat in
Yeah.
oil right now. No matter what, even with the OPEC plus output cuts a couple of weeks ago, we're still in a range, right? We're still in a sort of 75, 85 range. The oil market's, hovering right below $80 now. So, regardless of the output cuts, we haven't done anything technically to break the consolidation range. So until we do that, once again, it's 75, 85 until further notice. So what's gone on more materially in the energy markets is that the crack spread is backed off from about 40 to around $30, which has been significant. The refiners are all sort of off of their highs now and testing their uptrends. So that's another one of the trades that the market's giving you, Maggie. If you believe in, the gasoline demand story globally, which has been, the story that's kept the energy market propped up, then you can buy refiners on this dip. They've all backed off the highs. The crack spread has gone from 40 to 30 for the fourth time this year. So if it stays in a range and trades back up, you'll see the refiners come back and make new highs. And we know that their margins have been dramatically expanded, and that is filtering into earnings. So there's some upside to look for there too. There's opportunity. It's just kind of hidden in a lack of volatility right now, if that's fair to say, Maggie.
Yeah, no, and a lot of people talking about that lack of volatility. In fact, I think we had the VIX down again, right? I think it is below. Did it get below 17 again? Does that
Yeah,
Are you watching that, or is there other stuff going on? I know a lot of people are talking about those one day um options expirations and stuff. I mean, what do you think when you see the VIX like this?
yeah, well, the VIX, our mode to approach the VIX, Maggie. Sorry, I'm just trying to get the chart in front of me so I can speak intelligently about the levels that we're trading. But our approach at TG Macro to the VIX is, we want to be buying during the panic when the VIX is up above 30, and we want to be letting those purchases out when the VIX melts into the teens, right? So that's the general strategy. And sometimes the VIX melting into the teens is just enough to cause the market to sort of sell off because it doesn't have much downside from there. It reaches the price of realized volatility and it's not going any lower. So what happens then is that you just see a reprieve in the VIX off of the lows, and that just generally puts a little bit of pressure on stock market as they sort of back off the highs. So I think it's important to understand that down here, the downside in VIX is probably limited. If anything, you want to watch it for, consolidation and signs that, it might pop sometime soon, and maybe hunt down that trade where there's a waterfall coming, with the curve at minus 60 basis points, the VIX at 15. You say, well, man, if there's an opportunity for me to put some equity hedges on, it's probably right now, with the VIX super cheap, and a thought process like that. So I don't think that there's anything wrong with that thought process. I think it's very, very important to understand, not as much to trade the VIX, but more importantly, know where the VIX is and why it's there, so you can make
Mm.
educated decisions about the rest of your portfolio, and sort of really, really tactically decide how long you want to be, in the stock market. And so, yeah, it's a really intricate part of the tactical trading process, without a doubt.
Yeah. Which you're always so great about sharing with us. Trillion X asking, Tony, would you buy the dip in tech?
I'm still of the mindset that this rate reversal in March was real, right? That was a 12 sigma rate reversal. It's something as a trader that you think about, and it wakes you up in the middle of the night and reminds you, like, that's what the market is still working off of, right? It's still working off of the fact that yields reversed with the Silicon Valley blow up, yields reversed with inflation dramatically backing off the highs. And while I do think that we are still living in a world where we've got politically structural inflation,
Mm.
central banks are in fact doing a good job at battling that, as we can see from the headline data, where there's absolutely no inflation scare in the number. Now we pulled back from, say, 9 to, call it 5.5, 6% inflation or something like that. And once again, Maggie, I sound like a broken record, but if the administration is going to continue to push this move toward net zero as hard as they are, to me, that's politically structural inflation that at some point is going to creep back into the data and probably keep it from descending back all the way to 2% CPI, for example.
Yeah.
We probably find a level before that, level off. And then I'm sure we'll see periods, over the next 12 months where we'll see upside pressure on inflation again, and maybe upside pressure in yields. But that's the battle going on in the markets, and we're just trying to surf it here with the securities that we're trading.
Yeah. Michael Z asks a question. I'm gonna shorten it, Michael, and I hope I paraphrase you well, but sort of asking what happens if the Fed just pauses and holds on rates until something else breaks again, and brings up the fact that we're, approaching that whole debt limit fiasco,
It can,
dog and pony show in DC. We do seem to always think that they're either going to hike again or they're going to start cutting. What about that just extended period on pause? Is that priced in the market at all?
Maggie, that's a great point. I can't say whether or not that's priced in. I would say that that's something that's probably difficult to price in,
Mm,
but I could see a scenario where CPI has backed off the highs dramatically, right? I could see a scenario where CPI or PPI data gets persistently sticky up here and doesn't want to back off. But the Fed is in a position where they say, well, we don't really want to raise rates right now with the state that the economy is in, or the state that the global economy is in. It might be a little bit precarious post bank blow up to be raising rates right now. And so that could be a situation where inflation creeps back into the picture and turns the rates markets around, right?
mm.
Turns the bond market into a bit of a sell-off if the Fed doesn't do anything. So we'll see. I'm a believer that the short end of the curve is what's going to keep the Fed's hand to the fire in terms of inflation coming back into the picture. And we'll see if the bat signal, otherwise known as 2-year yield, starts taking off towards the highs again. We'll know that the commodity markets are going to hold the Fed's hand to the fire and try to get
Mm.
another rate hike out of them. But that's not the way the interest rate markets are looking right now. So we'll see what happens in the next couple of weeks.
Yeah. Yeah, it's really tricky, and this is why we're gonna just be, hawking on that inflation data and just trying to tear it apart because I think it is gonna really hold the key. It's interesting that we're talking about sort of strategy in this environment because it is important. It's been choppy. A lot of people have been asking about getting stuck in the chop, what to do. We have asked people asking, should I buy the dip? I had the chance to sit down with Andrew Rosner for my podcast, My Life in Four Trades, and he shared some of the lessons that he's learned over the years. Let's listen to a clip of that and then we'll talk on the other side.
And simply losing less is easier than winning more. Losing less is easier than winning more. In the exact same way that cutting the fastest way to increase profits is not to grow revenue, it's to cut costs, right? It's the exact same thing. It's just applying the same principle to two different things. Just losing less is easier than winning more. And so just if you can take money off the table, I do like the mantra of, never sell everything, keep a little bit, Jason Calacanis has a saying, he calls it schmuck insurance, always keep 10% as schmuck insurance. You just never know, right? And I like that. I think that's an important mantra too. But really just always, if you're winning, if you look at your P&L and you go, I am up more than I ever expected. If you are looking at your P&L with a big old smile on your face, that is the leading indicator that it's time to take some money off the table. Like, sure, let your winners ride, but take your initial principle off the table.
The video version of that conversation is available on our website. Andrew has an amazing life story, including how he got started. Really, really sort of wild how he came to be an entrepreneur and a VC investor now. And we also talk about $1 billion missed opportunity. Or basically, he left $1 billion on a table from a deal. And he talks about having to live with that, which is insane. If you're not already a member, scan the QR code, or you can listen to the podcast wherever you get your podcasts. But Tony, I know that's something that you talk about a lot too, about trying to have the discipline to, make sure that you are taking your profits when you need to, looking at your portfolio, being honest, listening to the market signals like you were just talking about.
Yeah, I mean, I kind of wrote about it this morning. I was kind of struggling to think about what to write to my subscribers, and I, got back into my basically into my routine when I started thinking about it. I was like, the reality is that I wake up Monday morning and I'm doing what I always do. I'm looking at my pad and then I'm looking at the market and I'm seeing what could kill me this week, and just trying to figure out like, what could possibly go wrong with what I've got on the books. And that lends itself, you have to be a little creative, right? You have to think of things that haven't happened yet. You have to create scenarios in your mind that, go against what you think, to figure out what might blindside you, but at least that makes you prepared for a sort of attack on your portfolio. And if you're prepared for an attack on your portfolio, then you have an escape plan and, an emergency plan. And you have that plan for when you get punched in the mouth, like Mike Tyson says. And then you can just react with no emotion, and so that's kind of how I like to handle things at a certain level myself. And being as successful an entrepreneur as that gentleman has been, I'm not fading a thing that he has to say.
No, yeah, exactly. But I think it's fantastic advice, just, making that part of your routine. So we've got all kinds of questions coming in, but a lot of chat about the debt ceiling issue. So I just want to revisit that again. So, there's debate about the timing. There's also, everyone sort of knows they do it at the last minute, but there's always that concern about what if they get it wrong and, what if they blow past it? How are you thinking about the risk around that?
I don't, Maggie. I really don't. Now, I understand that it has moved 1 month paper dramatically, right? It's important to see what the debt ceiling conversation is doing to the markets, if it's doing anything into the markets. But I have a very broad noise cancellation policy on that whole discussion. In fact, I mute the words debt ceiling on Twitter because I do not want to hear the noise that they talk about going back and forth. As long as I have one eyeball on 1 month yields and I understand that they've been thrown for a loop due to this discussion, and I know that that kink in the 1 month curve is not affecting anything that I have on my pad immediately, I'm going to tell you that in a couple of weeks, we're not going to be talking about any debt ceiling.
Yeah, that is usually the answer we always get from traders because you've got to concentrate on what really matters. So we have a question. I'm laughing looking. We have a question from Eric H. Is there a level on MSOS that you cannot resist buying, and is that level $5? I
Yeah.
like that very specific ending of that,
He's
Eric.
leading the witness. He's leading the
He
witness.
is.
I tell you, the cannabis market is just unbelievable right now, right? I mean, the baby is being thrown out with the bathwater. I don't know what to say. You know, I reach out to my friend Jason Wild, who is one of the biggest operators in the industry, and I just tell him, I hope you're doing okay through all this. And it seems like he still has a smile on his face and it's business as usual for the actual multi-state operators in the stores themselves because they're busy with building inventory and building a business. But the industry is just bidless on Wall Street right now. So, I wouldn't bid $5 if I've got a chance to bid $2 because that's the way it looks like the direction is going. And believe me, I understand at some level the prices will get stupid. They'll consolidate forever. The industry will lull everybody to sleep. And then all of a sudden, safe banking will pass
Mm.
and the world will change. But I'm kind of resigned, having gotten the scars trying to play it from the long side. I only give myself a couple of swings at that trade and then I'm out like any other baseball player. And right now I am sitting in the third row of the cannabis stands spectating because I have no business trading the sector from the long side until I've got catalyst, proof of price action, proof of performance. I can draw a picture of the breakout on the chart that looks like all the other breakouts that I've seen in my life. And until I get all of that lined up, I'm sitting here watching cannabis go down, man. I don't know how else to do this.
Yeah, it's funny. We haven't talked about it in a while because you sort of basically said you took yourself out of it. But we got a couple questions on it today. So obviously things are getting to the point where people are interested. And if you're not familiar with MSOS, it's Advisor Shares Pure US Cannabis ETF. We have another specific. Somebody also said, "Wait a minute, it's not Tuesday," but that's okay. Can the market? Nico's asking, can the market rally as small caps are still on the floor?
Ooh, Nico's good question, man. They were the epicenter of the post Silicon Valley bank blowup, right? So I would imagine that the stocks that are down due to that can stay down for a while. Man, it's hard for me. It's hard for me to have a view on the Russell when I'm so focused on this Nasdaq trade. I'm kind of
Mhm.
focused on another trade at the moment, not the sort of Silicon Valley bank cleanup trade, but rather. Um, I suppose, rather the lower interest rates spurring the home builders and technology sector trade. So I
Yeah.
guess since I'm chasing down that angle, um, I don't have as strong a view on the small cap stocks. But I do think that the market can still work its way out of here and have the Russell be a sort of drag behind, with all the small cap stuff that's still damaged and all the banks that may not rally out of the hole. I just think that that's going to be a little temporary, um, little tell in the markets now where small cap stocks are a little weaker.
Yeah.
It's really, really, it's tough to play coming out of the bank blow up and kind of having your eyes on the tape for another body floating to the top. But I think in the absence of another body floating to the top, we'll see them catch up and kind of get more back in line, if that's fair.
Yeah, absolutely. And we will, as the weeks go on, a lot of attention on what this potential credit contraction will look like and what that might mean for small businesses as this bank situation plays out. So we'll keep an eye on that as well. Uh, this is a great question from Roger. What's a normal crack spread? Normal.
Oh, so the normal range for the crack spread is anywhere between $5 and $15 historically, right? That is the price where the refiners crack 3 barrels of WTI crude oil into 2 barrels of diesel fuel and 1 barrel of gasoline, right? During the Russian invasion a year ago of Ukraine, I guess the retaliation of the NATO invasion of Ukraine, if you want to look at it realistically, they got as high as $60. And that was just a function really of, firm gasoline demand into a tighter refining market, right? The refinery output has been going full steam pretty much since then. And so that spread has just sort of been, um, I guess, trading back and forth at the high end of this historic range between 30 and 40. And it's really because the global gasoline demand is still there. So as long as refineries are operating with margins that are 3 or 4x their usual margins, that to me is the tip of the energy iceberg, tip of the energy spear, and a place that I can try to tactically trade from the long side, knowing that this is a sort of total anomaly in the earning structure for these refining companies.
Great question. Thank you. We had
Was a
the
great
right
question.
person here to ask that question to. So thanks for putting that in there, Roger. Um, SBD 758. What gets oil to $100 a barrel or beyond?
I think it's going to wind up being that China reopening to full steam, China airline capacity getting closer to 100% of the pre-lockdown levels. I think we might, if God forbid we see an economic uptick, which is to me is a possible scenario. Everyone's looking forward to the recession, but I feel like the market has already seen a recession and is almost pining for the recovery. And that's one of the trades that I'm going to be hunting. I don't know if it happens next quarter or next year, but at some point that curve is going to start steepening again with an economic recovery in mind. And that's when we're going to get the chance to lean into all the industrials, cyclicals, and trades like that. And those are going to work like a charm. And they may go on for months and months and months as we dig ourselves out of this economic malaise that we seem to be in. But that's still a trade for another day. Right now, we're dealing with a range bound yield curve buried at the lows of the move, where we've got to expect economic snowballs going through the window and rattling the bond market. So as long as that's the case, I can't expect much upside in equities. But once again, we'll roll out of this period, and eventually we'll see that yield curve steepen, and we'll have a different trade to hunt down.
Sam, what does Tony think about silver or silver miners?
Tough to fade them. Generally in my past, I've chased the silver trade all over the screens and all over the board and all over the world. And I've bought the highs and bought the lows and laughed and cried and gotten killed and everything like that. But I have to tell you, the silver trade is a really difficult trade. It's still the rich man's casino trade. I much prefer, to give you my honest opinion, to just be long physical silver and not think about it as much. I understand that there could be some percentage gains to be had in the silver market, and it's an undervalued precious metal, et cetera, et cetera. To me, that trade, like I said, I've chased it around so many times, and I'm probably 50-50 on it over the course of my lifetime. So yeah, it's got potential just like gold does. And if gold doesn't get through that 2100 level, and if sort of silver doesn't get through, I guess, the top of the range at about 28 or so, we're going to be in for another story of a lot of disappointed precious metals bulls. And
Yeah.
not to say that I'm rooting for that, because I'm not. I hope that I'm a believer in gold and silver. I'm bullish gold and silver. I just tend to sort of stay away from silver the way I stay away from natural gas, in that it is much more of a rich man's casino. And I have much less of an edge in it than I think I do, if that's
Yeah.
fair to say.
And that is a really humble thing to say too, because a lot of people get sucked up. I think that your description of chasing it around the world, it sounds like there's a rock lyric in there somewhere, I
Yeah,
think.
right. Yeah, it really is. There may be a song in that.
I think so. And speaking of natural gas, Yo-Yo asking, last time you said you could see natural gas at $1. Where are you now?
It still looks like a random number generator to me. It's definitely not trending. It is definitely consolidating and throwing bulls and bears off the track. Like we had a pop up to 230 that reeled in a whole bunch of new bulls, and then we dashed everyone's hopes and traded down to $2 again. The bears got beer muscles and shorted it below $2 again, and it popped to 235 again. It looks like it is a capital combustion area to me. And I think that I kind of want to stay away from it until it starts trending and proving itself. And I'm hoping that I recognize that, because I've seen it go from 2 to 12 about 5 times in my career. So if that
Yeah.
starts to happen again, I'm going to bet on myself to be able to get in there and clip a couple of percentage points of that move.
Yeah, it's the sort of golden ticket, right? But it's a tough one, so you gotta be careful.
It's the
One last
impossibly
question because
timed golden ticket.
yes, Paul, this is our last question. Paul asked it early, so I wanna make sure I get it in. What did you make of the Bitcoin dip over the weekend while everything else held?
Yeah, I hate that Bitcoin trades over the weekend, so I don't know what to make of the dip over the weekend. Other than it's your guys' fault for letting them keep it open. So, it's hard for me still. Bitcoin, it's got tremendous technical potential. It's got tremendous fundamental potential. Right now it feels like, sort of on the, I don't know, cultural, socio, I don't know, so political, socio
Mhm.
scale that the market is kind of clamoring for something like that, for that currency that's, you know, got no Fed governors and is really a fairer place to trade and to have your capital. But it continues to disappoint too, and it's got the U.S. Gov as its arch enemy, looking to float its own competitive, digital currency at some point. So I'm just not that good of a cryptocurrency trader. I can spot the breakout and I can smell when it's going to rally on the charts, but I just can't find what the real driver is in terms of, where's my where is my, related trade? Like, is it rallying because rates are going down? Is it rallying because the dollar is going down? Is it rallying because of the de-dollarization talk? When I can't really get a handle on it, I kind of stay away from it, and that's where I am in cryptocurrency right now.
Yep, and it's the answer we get from a lot of folks, who may for the fantastic summary you just gave, but just say, "I can't understand it exactly," and so if I'm a trader, I can't really, like you said, predict, then I've gotta stay out of it for the
So
moment
far, I
anyway.
think I'm 0 for 3 with questions they fired at me. I've been basically running from every security that anybody asks me about.
No, but the reasons why are priceless, and that's what, that this is a sort of, I think, mental framework that people have to operate on. You can take a punt, but if you don't really understand it, it's a lot
And
tougher. So we
it's
appreciate your honesty, Tony,
yeah,
as
no,
always.
it also, it's worth mentioning just for to add some value is that, when you think about, where do you want to put your money right now? And I was just on a podcast with three other guys that we call the macro avengers, and my friend Brent was like, I like cash. And that's perfectly reasonable. It's
Yeah.
perfectly reasonable to have a lot of cash on hand and very few positions, because like we've gone over before, especially in that conversation with Denise, where there's nothing better than having dry powder. So
Yeah.
if you don't have an opinion, then have a lot of dry powder so that when something falls in your lap, you can trade it with a clear conscience and from a fresh start.
Yeah.
It's always kind of sloppy to have a scenario unfold on the screens and you look at your pad and say, "Oh, I don't really have room for that unless I rearrange this, get out of
Mhm.
that, cut this down," and that sort of takes away from the power of the trade, quite honestly. So it's
It
always
does.
valuable to have a lot of cash on the sidelines or to just be sitting in cash with no opinions.
Right. And you can't trade everything well, so you have to trade the things that you know well. That's the other lesson that a lot of you share with us, and I think it's a really valuable one. You've got to be in what you can understand, for sure.
Absolutely. If you don't have an edge, keep your hands in your pockets.
I love it. I love it. We're out
Always.
of time, Tony. As always, fantastic to catch up with you. I know you're gonna go have some fun tonight at the
Yeah, go
playoffs, so
Rangers tonight.
enjoy. That's right. Go Knicks. Go Knicks, everybody. Sorry for all you out there who may not beat Team Nick. But thanks to all of you for being with us as well. We'll be back tomorrow with Andy Constant. In the meantime, take care and good luck out there.